Hey everyone, excited to be here this week. There was a lot of green across the market, and today we're going to be talking out all the things that I am paying attention to, things that I think are important here. We're going to be going over market indicators, US economic news, China economic news, as well as portfolio updates with GXO, OPRT, and CPS announcing earnings this week. So with that, guys, we are going to jump right in. For any of you guys that are new here on this channel as well, my name is Kyler Johnson, and for the past 7 years, I have been learning and growing in the market and studying all kinds of different strategies, and I've learned that the best focus that I was able to find for me is on finding companies that are trading below their intrinsic value. And this strategy allows me to create excess returns without taking on excess risk. And on this channel, you guys can know that I am literally putting my money where my mouth is every single time. These are actual investments that I am making for myself and my family's future. So with that, guys, we're going to go right into some of the first things that I saw this week with some market indicators. And right before we get to that, here was a quote as I was rereading and going through The Intelligent Investor by Benjamin Graham. This little piece in the commentary by Jason Zweig, where he lays out 5 signs that a company has a moat or competitive advantage. They have a strong brand, they're a monopoly or near monopoly, they have economies of scale, they have unique intangible assets, and a resistance to substitution. Moats are incredibly important to pay attention to, and I think myself included throw around the term moat too loosely. There are very few companies out there with actual moats. You've got companies like Apple, Boeing, Coca-Cola. There's tons of others out there that might be big name that you know of, but when you actually dive into the total amount versus all the companies in the market, it's a very small percentage that actually have a moat. So you got to really pay attention and look for those that do. I'm not going to be investing in only companies with a moat. They will still have to be very high quality, but it's important to understand this concept because when you're investing in high quality companies, you put yourself in a position where even if you buy them at fair value, you're going to do very well in the long run. So moving on to the fear and greed, started the week at around 40 and rose to about 50, which was interesting when the market was really rising much quicker. Just interesting there. Also got the National Association of Active Investment Managers right here, and this tells us how long the active investment managers are in the market currently. You saw on the recent dip, they got fairly low to a point where it was definitely more of a buy signal than a sell, not anything major in any one direction, but maybe a slight lean to a buy. You can see now that it's gotten much more aggressive here. Some interesting news for the market, as well as the 52-week highs. You guys can see bouncing again, coming off the lows. Still got nowhere near the high, but kind of in a more neutral territory. The breadth and momentum, again, kind of came off down low, even though this was a small pullback. You can see how far all of these indicators really fell, telling us that things were potentially oversold. Not necessarily the lowest they've ever been, but maybe a slight lean there. And I don't use these to determine, am I selling my positions, am I getting out, or anything like that. It's just more of, if things get to an extreme level, I might look for asymmetric bets to take really, really small position in my portfolio to capitalize on short-term dislocation. But again, this is not a huge deal, but it's important to pay attention to. It gives you an idea of where the market's potentially going to head. This still has a long ways to go before it is at some of these peaks that we have been used to seeing, which indicate that things might be turning around, breadth improving there. The new high and low percent, you guys can see again, this just dropped off a cliff just in this little dip right here and is on its way back up, nowhere near the highs, kind of in a neutral territory. Moving on to the 10-year yield, you guys can see here, started the week at 4.461 and rose slightly to 4.5. I have a bet on this that we started back here when rates were a little bit higher, that the Fed stepping in with more bid into the bonds is going to be pushing this lower. I expect this to continue, but we will see kind of what happens here. Moving on to the AAI sentiment survey, you guys can see from last week, a couple more percentage went bullish, but a large percentage of the bearish turned neutral. And not really a signal here, but it's interesting to pay attention to when things get to extremes, then we can look for potential bets just to add a little bit more performance to the portfolio on the year. These are some of the indicators and things that I'm looking at. Overall, things are pretty neutral. I expect maybe a slight bullish tilt to things, market continuing up, but I never have any bets that are going to rely on any short-term movements for the most part. And when they do, it's because things were drastically oversold in one direction or another. And even if they blow up in my face, they're a tiny percentage of the portfolio and will still allow me to outperform for the year, even with those going to zero, which I don't expect they would. Moving on to U.S. news, at the beginning of May, of the 80% of the S&P 500 companies that have reported so far their results, 81% are beating profit estimates by a median of 7%. Meanwhile, 61% of companies have beaten revenue estimates by a median of 4%. Guys, this tells you that even though consumer sentiment is dropping, companies are doing well right now. Since then, more companies have reported, and I would guess that it's probably pretty close to in line with all these stats that we're seeing here. Their profits are beating, 81% of profits are beating. This means margin reacceleration for these companies. Revenue is only 61%. That's probably more normal for the market, but this tells me, hey, margins are reaccelerating here. Another article from Bloomberg, U.S. stocks advance across the board as higher than expected jobless claims rekindle bets the Fed will be able to cut rates this year. In the most recent Federal Reserve meeting, Jerome Powell specifically mentioned an avenue by which they would be cutting without inflation coming down, and that was if they saw job market really starting to soften. And we got a couple data points this week that pointed to that. They would need a whole lot more for it to actually indicate that they would need a cut, but nonetheless, it was some good news for the market, expecting things to come a little bit more into balance and more of the reason for the Fed to cut rates. Found this as well from, you guys can see the Kabasi letter, the small business optimism, and they pulled it from Bank of America Global Investment. The small business optimism is at an 11-year low, and I had an X or tweet, whatever you want to call it, essentially going over the idea that when things get to these extremes, it usually means that there are high quality companies that people are completely depressed about. They are trading for below their intrinsic value, and you can pick up companies for pennies on the dollar that obviously are not going away. People have just decided that there is no hope. They swing from one extreme to the other, where nothing can ever go wrong to nothing can ever go right. And when people are saying nothing can ever go right, they are just wrong. And if they are correct, then we will have much worse things to worry about than how the stock market is doing. So either way, it doesn't matter. So we can go in and we can pick up companies that are trading for far below their fair value when optimism is low. So this tells me, hey, the Russell 2000 or small cap companies might be really good to look at right now as sentiment is so poor. So interesting things there. Some other things that I found from New York Times, they said billions in chip grants are expected to fuel industry growth. The United States will triple its domestic chip manufacturing capacity by 2032, the largest increase in the world, according to a report from the Semiconductor Industry Association. There is a ton of money flowing into all these companies, especially one that I'm particularly looking at that's been beaten up, Intel, not at levels that I want to purchase now, but it's getting there for sure, where they have received billions in grants and loans from the government to build more foundries, to produce more chips for the country as we try and, they're trying to push the U.S. to be independent, be able to produce everything in-house here or get close to it. So there's going to be a lot of money flowing there, and it's why I'm really paying attention to Intel to potentially take advantage of that right there. Now moving on to some China news. As you guys know, if you've watched any of my previous videos, I have large position in BABA. It's one of my favorite positions that I have right now, and this was some great news. Starting to see a turnaround in China as their exports and imports return to growth, signaling demand recovery. People have been so depressed about China and investing there that it made it a fantastic opportunity to put money to work. And now we're starting to see the turnaround actually happen because things are never as bad as they seem. China was not going to blow up and disappear. They were still going to be around. They've got over 1 billion people. They're still trying to make money, grow businesses. They got money to spend, and it's going to show up. We'll see if this trend continues, but you can see their imports year over year grew 8.4%, which was 3% higher than the forecasted growth. That's pretty crazy there. They're bringing more product in to fill demand, and it's happening quicker than they forecasted. Exports as well. Their manufacturing is potentially picking up here, growing 1.5% versus the 1% estimated. So we will see if this trend continues, but that was some good news for China. They also saw their CPI rise for third month, signaling demand recovery. In the past, China had been in quite literally deflation, not with inflation going down, which we're here in the US calling disinflation. We're talking actual deflation where prices were going down across the board, which can really spell disaster if it continues because consumers will start to hold on to their money and not spend because they think prices could be lower later. And that's just a self-perpetuating cycle where consumers holding on to cash makes prices fall further to try and stimulate demand. And as prices fall further, consumers are more willing to say, hey, I'm just going to hold on to it because prices will keep falling. Can be a real problem, but you're seeing they're turning that around, and spending is coming back, and we're going to start seeing this. I'm excited for BABA and other Chinese companies to report this coming week, and we will see what they have in store. I expect good things, and we'll see if the management is executing on everything they want. Some other news, the UK exits recession with fastest growth in nearly 3 years. According to Reuters, Britain's economy grew by the most in nearly 3 years in the first quarter of 2022, ending the shallow recession it entered in the second half of last year and delivering a boost to the Prime Minister Rishi Sunak ahead of an election. Gross domestic product expanded by 0.6% in the 3 months to March. The Office for National Statistics said the strongest growth since the fourth quarter of 2021, when it rose by 1.5%. This is fantastic news for GXO, which we're going to be talking about later, but just tells you, again, things are never as bad as they seem, and across the world right now, countries are returning to growth. Things have really been pessimistic, and we'll see what happens in the coming years as spending kind of picks up. We'll see if it's sustainable, but across the board, just good news here on spending. Now going on to some of the portfolio updates with some of the holdings, like I mentioned, reporting earnings this week. First, going into Boeing. You guys have heard non-stop terrible news about this company. And as if you've watched my previous videos as well, you'll know I love it. The more bad news we get here, the better. I hope bad news continues to push this stock down another 30% from these levels, because this is a company that's going to be sticking around, and it only has one real competitor, and they can't handle all the demand in the industry. Between the two of them, they have years worth of back orders and are getting quite literally hundreds more every quarter. They're companies, they need more planes, and these are the only two between Boeing and Airbus that can supply them. Even though Boeing is not being run well currently, I think they're going to be making the steps necessary because they have to. They're a company that has to stick around. They operate in a duopoly, just like we talked about above. A monopoly or near monopoly is a moat, and I think Boeing fits fantastically in there. I'm excited for this company's future, and in the short term, I hope they crash and I'm able to pick up a lot more at lower levels because I'm excited for their future. GXO Logistics reported earnings this week. Here's some of the highlights. The revenue was up 6% year over year at $2.5 billion. They reported a net loss of $36 million, which was a decline, but it was due to a one-time litigation expense. Nothing to worry about there. There's nothing I was concerned about. Free cash flow was a negative $17 million in Q1 2024, an improvement of $43 million in 2023. They have historically poor Q1 free cash flow and improves as the year goes on. So again, no worries there. New business wins. They secured approximately $250 million in annualized revenue, marking a 55% increase year over year on new business wins, which is awesome to see. And they also completed a strategic acquisition of Wincanton, enhancing growth prospects in Europe. And they stated they expect this to drive double-digit growth in EPS post synergies. After they're able to really incorporate Wincanton into their process, they're expecting their earnings per share to grow at over 10%, and that's going to be fantastic to see. This is my whole bet with this company. The CEO here used to run a company called XPO Logistics, and they broke GXO out of that, and he was the one placed in charge. Previously, he was also the CEO of XPO, and before that, the managing director. And they were able to grow because of many profitable acquisitions, just like they're doing here with Wincanton. Their 2027 goals, 2024 to 2027, organic revenue CAGR of 10% to $15.5 to $16 billion of annual revenue, 15% adjusted EBITDA CAGR to $1.25 to $1.3 billion, and a greater than 30% conversion of adjusted EBITDA to free cash flow, and operating ROIC of more than 30%. These are phenomenal goals for this company. I have no doubt they're going to be executing here. The management is great, and they, so far, from what I can tell, have just been reaching these goals quicker than they have guided. So we'll see what actually happens here going in the future. But this is just a phenomenal company, and they're executing. All they need to do is continue on the trajectory they are going. So not a huge update there, but just to give you an idea of what some of the things were. They believe I popped a little bit. It was only a few percentage points the day of, but just wanted to say the fundamentals are the same, and they are executing here. Next company that reported earnings was Oportun Financial, ticker symbol OPRT. And here are a few slides from their earnings call. They had a resilient total revenue of $250 million under tight credit posture, which is down a little bit year over year, but they had tightened up their requirements on their loans for the creditworthiness of their clients. And because of that, their revenues have fallen a little bit, but as you guys are going to see, I think it's proving to be a very, very smart move for the company. They were also to cut operating expense 25% year over year. This is my main bet with this company, that they are just going to cut away all the fat to actually become profitable, which if this was the first quarter that they returned to profitability. Adjusted net income profitable, improved $61 million year over year, and it's awesome to see. They expect further operational improvement throughout the remainder of 2024. Operating expenses to trend down to $97.5 million by Q4 24, which is a further improvement of about $13 million a quarter. They raised full year 2024 revenue and adjusted EBITDA expectations by 31% from their midpoint. That is a huge beat and raise that they had here. And because of it, if you guys look at their chart, they really popped on this. And on some previous news that they were executing on bringing in other experts to help advise on the company's situation. And they're starting to execute. Still have a long ways to go, and I still want them to prove they are sticking with this. But some good news here for a company that I would probably consider my lowest quality in the portfolio. We will see what happens here. I'm excited that currently we're about a double from where my basis is, but it's got plenty more room to run. They also listed their 1 to 29 day delinquencies is now running well below 2023, which is great to see. They targeted, like I said, 97.5 million in Q4 2024 operating expenses, a 38% reduction from the second quarter of 2022, and they'll save about 240 million on an annualized basis. Their first quarter 2024 portfolio yield is up 113 basis points year over year, and risk adjusted is up 120 points year over year. The loans that they do have outstanding are more profitable. They're having less delinquency, less write-offs and things here for uncollectible amounts, and seem to be just operating overall better, and they're doing it while cutting costs. They're also ramping up secured personal loans program, which had about 350 basis points lower loss rates than unsecured personal loans. So that should help also boost their profitability. We'll see how they execute on that. They do have a history of spending too much on operating when they are rolling things out. We will see. This is already something they've done before in the past, so we'll see how they execute on that. Some other things as well. They're offering some of their products in different places across the country, which is great to see. Their guidance versus actual as well. You can see they beat their high end on every single one of these. On the annualized charge-off rate, they were right at their high end. I guess low end here, which is good. But they beat all expectations here, beat all expectations here on revenue and adjusted EBITDA, which is why they had that fantastic beat and raise here. Exciting to see a company executing on this and executing quickly, which is great to see. Their full guidance for not only the second quarter, but the full year, you guys can pick up on that here. For the full year, you can see bringing, again, the net charge-off rate down 11 to 11.9 and having adjusted EBITDA of almost getting into the 100 million, which will be a good milestone for the company. They reduced OPEX and improved net income. So some more good news here. And on their earnings call, they said, we are confident in our outlook and have raised our revenue and adjusted EBITDA guidance and reaffirmed our expectations to be profitable on an adjusted basis this year. We expect to exit 2024 with an annualized cost structure that is 240 million below peak levels and near elimination of our back book. And we intend on driving the business towards the 20% to 28% ROE we talked about in March when we first presented our target unit economics model. This is a fantastic goal, and I'm glad that they are now seeing this coming down the pipeline. 20 to 28% return on equity is phenomenal for this company. I don't think this is one that I would be holding long term just because of the low quality of their management, but it's great to see that they have this in mind. So another thing they said overall, I really like the progress the Oportun has made here, cutting costs in the business and very quickly turning profitable. Don't get me wrong, for sure. This is not a green light that they are out of the woods. There is still work to do, but it's a very promising sign. Now it's up to them to actually execute. A couple quick pieces on Alibaba. They went to overhaul Taobao in strategic move to reclaim e-commerce dominance. And by overhaul here, from what I could tell, they were really just trying to revamp the consumer interface online just to freshen things up, to drive more traffic, so when people go on to buy products from Alibaba, just feels more professional, smoother, really just kind of rework that to get more out of Taobao, which is one of their largest segments along with Tmall. So great to see that there. In the South China Morning Post, they said Alibaba says, I'm not even going to try and pronounce that. Alibaba says its AI models are used by over 90,000 corporate clients in China. The company's LLM series, known as Quen, is in industries ranging from consumer electronics to cars, with clients that include Xiaomi. Since some 2.2 million corporate users also have access to Quen-powered AI services through Alibaba's office collaboration tool DingTalk. So this company not only has a fantastic retail portion that I don't think gets full credit, but they are also a massive player in not only large language models, but the cloud, and really anything that is getting overhyped here in the US right now. Alibaba is a huge player over in China, and it's a fantastic play to really get a free lottery ticket, because we're really only maybe getting credit for part of their retail side and not really any of their potential in the cloud in AI. And they're going to be a massive player here, not only working with some of the largest corporations in China, but also in Asia there. And it's going to be really, really exciting to see this company absolutely compound capital in the next few years and return to growth, as a lot of these things bounce back from just what we saw from consumers starting to spend again, which we saw earlier in the China economic news. Now, lastly, we are going on to Cooper Standard, which reported earnings as well. As a summary, their gross profit totaled $61.6 million, an increase of 47.4% compared to Q1 2023. You guys can kind of go through everything here on the screen, but they reported phenomenal numbers. Even though, as we'll talk about later, their free cash flow is negative, it's actually a good sign in improvement from first quarters in the past. On the call, they said, our first quarter operational improvements and margin expansion set a solid foundation for a strong 2024, said Jeffrey Edwards, chairman and CEO of Cooper Standard. Going forward, through our new product line-based management structure, we expect to aggressively pursue further cost structure optimization, leverage commercial opportunities to accelerate growth, and enhance value creation. Successful implementation of these initiatives is expected to drive meaningful additional margin expansion and should represent upside to our original full-year guidance, assuming industry production volumes hold, and we actually expect production volumes could rise here, which could spell absolute phenomenal situation for this company. The year-over-year negative change in first quarter sales was primarily attributable to the divestiture of their technical rubber business in the third quarter of 2023. This was a tiny little piece of their company that was losing money that they decided to divest from. So even though their revenue looks like it was down year-over-year, if you compare these segments that are left, apples to apples from last year, they're actually just slightly up year-over-year, which is cool to see. Moving on to some of their highlights here, they were able to save $19 million in manufacturing and purchasing savings here just on this quarter, which is awesome to see. And they had 300 basis points of gross margin improvement with the volumes returning to the automotive industry. We talked about last week that automotive sales were up 5.1% in the first quarter in the US, which Cooper Standard will benefit from greatly. Some other things, they also plan to have an immediate reduction in salaried workforce. They expect cost savings of 20 to 25 million in 2024 and a full annualized cost savings of 40 to 45 million in 2025. And they expect the payback of the restructuring costs to come in 6 months, which is an incredibly quick turnaround. These guys are operating even better than I could have hoped. Really, my only assumption with this company is that there was going to be a continued recovery in the automotive industry with sales and volume returning, which Cooper Standard was going to benefit from, but they continue to cut costs here, which means they're going to be operating more efficiently than they were when they were at their peak at 20 times price to earnings at about $140 a share. They're currently sitting at around $15 a share, guys. It's incredible this company is turning things around so quickly, in my opinion. And they certainly did have a scare of not being able to make debt payments, but they have talked a lot about restructuring things there, and now at a point where they have sufficient liquidity to really run through everything that they need, and they plan on a global refinancing, pushing things back. I don't remember the exact year, but I remember that they talked about that on the call. And like I said, turnaround of this company is going exactly as I would hope. With the management's continued focus on cost savings and efficiency, the industry itself is seeing great trends as well that seem to show continued improvement, as shown in the 5.1% increase in auto sales in the first quarter in the US. Guys, these companies are operating phenomenally, and I wanted to just give you guys an update on some of the things that I'm looking at. Really, when you're investing correctly, in my opinion, there are very few times that you actually need to make any moves besides potentially buying more of a good company. Selling and getting out of positions should not happen near as often as adding little bits to pieces of your portfolio as prices rise or fall and you see an opportunity to put money to work that makes sense. So with that, guys, remember, everything that I talk about here is my opinion and not advice. I'm just sharing my whole journey with you guys, and I hope that you're finding it valuable as we watch the markets each week and go over important things. So if you guys really like this, let me know. If you had any questions down below, definitely leave a like and subscribe to the channel. We're going to be having a video coming out every week and going over all of these things. So with that, guys, thanks for being here.